What if I told you that 30 days from now, you could be in a completely different position to buy a home? Not bought, not closed, but ready, financially ready. And that is actually the hardest part. I talk to people every week who have been thinking about buying a home for 2, 3, sometimes 5 years. And when I ask what is stopping them, most of them say the same thing: I just do not feel ready. The problem is not that they're not ready. The problem is they do not know what ready looks like. No one has ever laid it out for them in plain language. So today, I'm going to do just that. I'm going to walk you through exactly how to use the next 30 days to get financially prepared to buy a home. 4 steps, real action, no guesswork. I had a client a while back, a mom, I think of 3 kids, working a full-time job, doing everything right. She came to me thinking she was years away from buying. We sat down, we went through exactly what I'm about to show you, and she was under contract 2 months later. Not because she had no money, because she finally knew what to work on. Let's get into it. There are 4 things I need you to focus on in the next 30 days. I'm going to walk you through each one. Number 1, credit and understand your score. Step 1 is to pull your credit, not just check the number. Actually look at your full report. You are entitled to a free report from all 3 agencies, Experian, Equifax, and TransUnion. Go to annualcreditreport.com and pull all 3. They can all be a little different, and lenders look at all of them. Now, here's what you're looking for. First, are there any errors? A wrong account, a collection that is not yours, a late payment that was actually paid on time. These things happen more often than you think, and they can drag your score down for no reason. If you find errors, you can dispute them and get them corrected. Second, look at your balances. If your credit cards are above 30% of the available credit limit, that is hurting your score. For example, if your limit is $1,000 and you owe $600, that is 60%. Bring it down below $300 and your score will likely go up. And third, do not open any new credit accounts right now. No new cards, no financing a car. New credit inquiries can drop your score temporarily, and lenders will ask about any new accounts opened in the past few months. Step 2 is to figure out what you actually can afford. Not what you hope you can afford, what the numbers say. Lenders are going to look at something called your debt to income ratio. It is just a comparison of how much you owe every month versus how much you bring in. Most lenders want that number below 43%. Some will go a little higher depending on the loan type. So here's how you figure it out. Add up every required monthly payment, your car payment, student loans, minimum credit card payments, any personal loans. Do not include groceries or utilities, just the debt payments. Then divide that total by your gross monthly income, which is what you make before taxes. So why does this matter in 30 days? Because if your ratio is too high, you still have time to do something about it. Pay down a small balance. See if you can increase your income even slightly, or just understand that a smaller loan amount might be your starting point. Knowing the numbers is the whole game. Step 3 might feel like homework, but it will save you a ton of stress later. Start gathering your documentation now. When you apply for a mortgage, your lender is going to need proof of your income, proof of identity, proof of where your money is coming from. The earlier you get this together, the faster everything moves once you are ready to apply. So here's the basic list. 2 years of tax returns, your last 2 pay stubs, 2 months of bank statements, a government issued ID, and if you have student loans or a car payment, your most recent statement for those. I want to be honest about something. Most people who come to me do not have any of this ready, and that's fine. But the people who close the fastest are always the ones who did this part early. It takes maybe an hour to pull some of this stuff together, and put it in a folder on your phone or on your computer. An hour now saves you a week later. Step number 4 is about money in the bank. And I'm not going to tell you you have to save 20% down. This is not what most first-time home buyers actually need. There are loan programs that allow you to buy with as little as 3% down, some with 0% down if you qualify. What you do need is a consistent savings history. Lenders want to see that the money in your account has been there for at least 60 days. This is called seasoning the funds. So if you have a tax refund sitting in your account right now, this is a great start. Leave it there. Do not move it around. Let it sit. And if you can add to it even a little each week over the next 30 days, lenders will see a pattern of savings, not just one lump sum. The 30-day goal for savings is not to have enough to close. It's to have a habit lenders can see. That is what builds a story in your file. So before I wrap up, I want to flag 3 mistakes I see people make when they start preparing to buy. These are easy to avoid if you know about them. Mistake number 1, closing old credit card accounts. This feels like the responsible thing to do. Pay it off, close it, clean it up. But closing an account actually reduces your available credit and can lower your score. If you paid it off, leave the account open, just do not use it. Mistake number 2, moving money between accounts right before applying. I know it sounds harmless, but lenders have to trace every large deposit. If you move $5,000 from one account to another, they are going to ask where it came from. Keep money where it is. Consistency is what they want to see. Mistake number 3, assuming you need to wait until everything is perfect. You do not. There is no perfect moment. There are buyers who qualified this year who were told 2 years ago that they were not ready. Preparation is the answer, not perfection. And I want to bust one myth before I let you go. A lot of people believe you need a 700 credit score to get approved for a home loan. This is not true. FHA loans allow for scores as low as 580 with a 3.5% down payment. Some programs go lower with compensating factors. Now, a higher score does get you a better interest rate. That's real. But a 640 score does not lock you out of home ownership. It just means we look at which loan program fits your situation. And that's my job. The buyers I work with are not all starting from perfect. They are starting from real, and real is enough. So here's what I want you to walk away with today. In the next 30 days, you can pull your credit and understand what you're working with. You can calculate your debt to income ratio so you know where you stand. You can gather your documents so you are ready when it's time. And you can build a consistent savings habit that lenders will actually see. None of this requires a big income, a perfect credit score, or years of savings. It requires 30 days of intentional focus. That's it. If you want to sit down and actually talk through where you are right now, I do consultations for exactly this. No pressure, no sales pitch, just an honest conversation about what your path looks like. The link is in the top pinned comment and in the description of this video. You are closer than you think. I promise you that. My time is up, but I thank you for yours. As I always say, guys, let's be good to one another. Let us let grace abound. Watch these next 2 videos here. They'll help you in your education as you prepare to become a homeowner and achieve your goals. And for the rest of you, indeed, y'all stay blessed.